Thinking about investing in clean energy? The ACES ETF seems like a popular choice, but is it really all sunshine and rainbows? Today, we're diving deep into the ACES Clean Energy ETF. We'll uncover the hidden fees, surprising risks, and whether it actually fits your investment goals. We'll break down the expense ratio, foreign exchange risks, and how ACES ETF stacks up against its competitors. So, before you jump in, hit that subscribe button and let's see if ACES is the clean energy goldmine you've been searching for, or if there are better options out there. Stay tuned. What is the underlying investment strategy of the ACES ETF? The underlying investment strategy of the ACES ETF is passive management that tracks the performance of a specific clean energy index. Here's a breakdown of what that means. Passive management: ACES is not actively managed by a fund manager who selects individual stocks. Instead, it follows a predetermined benchmark, the CIBC Atlas Clean Energy Index, NASEX. The ETF aims to hold the same proportions of each company in the index as their weighting within the index. This approach offers lower expense ratios compared to actively managed funds. Clean energy focus: the NASEX index targets companies listed in the US and Canada that are involved in the clean energy sector. This includes companies working on renewable energy sources like solar, wind, geothermal, and hydro. Clean technology solutions like energy storage, smart grids, and energy efficiency. Benefits of this strategy: diversification: by tracking the index, ACES provides exposure to a basket of clean energy companies, reducing concentration risk compared to picking individual stocks. Exposure to growth potential: the clean energy sector is expected to grow significantly in the coming years due to factors like climate change concerns and government policies promoting renewable energy. ACES offers a way to participate in this potential growth. Cost effectiveness: passive management generally has lower expense ratios than actively managed funds, which translates to potentially higher returns for investors. What is the current expense ratio of the ACES ETF? The current expense ratio of the ACES ETF is 0.55%. This expense ratio applies annually and is a fee deducted from the fund's assets to cover operational costs. Here's a deeper explanation of what this means for your investment. Expense ratio breakdown. Percentage of assets: the expense ratio is expressed as a percentage, in this case, 0.55%. This signifies that for every $1,000 invested in the ACES ETF annually, you'll incur $5.50 in fees. Impact on returns: the expense ratio directly eats into the investment returns. A lower expense ratio translates to potentially higher returns for investors compared to ETFs with higher expense ratios. How it compares. Clean energy ETF landscape: the expense ratio of 0.55% falls within the typical range for clean energy ETFs. Some competing clean energy ETFs might have slightly lower or higher expense ratios, such as ICLN, iShares Global Clean Energy ETF, expense ratio of 0.41%. QCLN, First Trust Clean Energy ETF, expense ratio of 0.59%. TAN, Invesco Solar Energy ETF, expense ratio of 0.67%. Cost considerations. Annual impact: while 0.55% might seem like a small fee, it can significantly impact returns over extended investment periods. For example, a $10,000 investment in ACES ETF would incur $55 annually in fees. Over 10 years, this accumulates to $550, which could have potentially contributed to your returns. Importance of comparison: When choosing a clean energy ETF, comparing expense ratios is crucial. A lower expense ratio can make a significant difference in your long-term returns. What is the current sector allocation of the ACES ETF? The current sector allocation of the ACES ETF isn't a single, static category. Instead, it reflects a diversified basket of companies across various sectors that contribute to the clean energy industry. However, the holdings are weighted based on their relevance and market capitalization within the CIBC Atlas Clean Energy Index, ACEX, that the ETF tracks. Here's a breakdown of the current sector allocation, as of May 16, 2024, according to ETF.com. Top sectors. Electronic technology, 32.19%. This includes companies involved in manufacturing solar panels, wind turbines, battery storage systems, and other clean energy technologies. Utilities, 26.56%. This encompasses companies that generate, transmit, and distribute clean energy sources like hydropower, geothermal, and solar. Other significant sectors. Consumer durables, 12.77%. This might include companies that manufacture electric vehicles, EVs, energy-efficient appliances, and other clean energy consumer products. Process industries, 7.52%. This could involve companies producing materials or components crucial for clean energy technologies, like lithium for batteries. Smaller allocations. Consumer non-durables, 5.07%. Non-energy minerals, 4.36%. Finance, 4.05%. Other sectors with minimal allocations, less than 2%. Understanding the allocation. Dynamic nature. The sector allocation of ACES ETF is constantly evolving as the underlying index rebalances periodically. Companies with stronger performance or increased market cap within the clean energy sector might see their weightings rise over time. Focus on technology and utilities. The significant allocation towards electronic technology and utilities reflects the crucial role these sectors play in the clean energy transition. Technological advancements are driving innovation in renewable energy sources and storage solutions, while utilities are increasingly integrating clean energy sources into their grids. Diversification beyond renewables. While renewable energy sources like solar and wind are prominent, the allocation to consumer durables, EVs, and process industries, materials, highlights the broader clean energy ecosystem ACES ETF taps into. Importance for investors. Understanding risk-return profile. The sector allocation helps investors assess the potential risks and returns associated with ACES ETF. For example, a heavy weighting on technology can lead to higher volatility compared to a more utility-focused allocation. Alignment with investment thesis. Investors with a specific focus on a particular clean energy subsector, for example, solar energy, might need to consider alternative ETFs with a more targeted allocation. How concentrated is the ACES ETF? The concentration of the ACES ETF refers to the number of holdings it encompasses compared to the total investable universe in the clean energy sector. Here's a detailed explanation of its concentration and how it impacts investors. Current concentration. Moderate concentration. ACES ETF doesn't hold an extremely high or low number of companies. As of May 27, 2024, it typically holds around 50 to 70 companies. This falls within the moderate concentration range for ETFs. Comparison. Compared to some broad market ETFs that might hold hundreds or even thousands of companies, ACES ETF has a more focused approach. However, some niche clean energy ETFs might hold even fewer companies. Impact of concentration. Benefits. Reduced management complexity. a smaller number of holdings can simplify portfolio management for the fund issuer, potentially leading to lower fees. Enhanced exposure to key players. By focusing on a select group of companies, ACES ETF offers investors exposure to the leading players in the clean energy sector. Drawbacks. Higher concentration risk. With fewer holdings, the performance of ACES ETF is more reliant on the success of individual companies. If a few key holdings underperform significantly, the overall return of the ETF can be negatively impacted. Limited diversification. Compared to a more broadly diversified ETF, ACES ETF might not offer as much protection against downturns in specific subsectors of the clean energy industry. Does the ACES ETF holding weightings follow a specific methodology? Yes, the ACES ETF holdings follow a specific methodology based on the underlying index it tracks, the CIBC Atlas Clean Energy Index, NACEX. Here's a breakdown of the weighting methodology and how it impacts the holdings of the ACES ETF. NACEX weighting methodology. Market capitalization weighting. NACEX primarily uses market capitalization weighting to determine the allocation of each holding within the ACES ETF. This means companies with a larger market value, stock price multiplied by outstanding shares, will have a higher weighting in the index and consequently, the ETF. Liquidity considerations. The index provider, CIBC National Trust Company, might also consider a company's trading volume and liquidity to ensure the investability of the index holdings. Companies with low trading volume might be excluded or have their weighting capped to minimize potential tracking errors for the ETF. Impact on ACES ETF. Reflects industry leaders. By using market capitalization weighting, ACES ETF tends to hold more shares of larger, more established companies in the clean energy sector. These companies are generally considered to be industry leaders with a proven track record. Passive management. The weighting methodology is predetermined by the NACEX index, and the ACES ETF passively replicates this weighting. This means the fund manager doesn't have the discretion to deviate from the index weighting and select specific companies or adjust their allocations. How often does the underlying index of the ACES ETF rebalance? The underlying index of the ACES ETF, the CIBC Atlas Clean Energy Index, NACEX, rebalances quarterly. This means the weighting of the companies within the index is reviewed and adjusted on a quarterly basis to reflect changes in their market capitalization and ensure the index continues to adhere to its investment strategy. Here's a breakdown of how quarterly rebalancing impacts the ACES ETF. Maintaining market cap representation. As clean energy companies experience stock price fluctuations, their market capitalization changes. Quarterly rebalancing ensures the holdings in the NACEX, and consequently, the ACES ETF, reflect these changes. Companies with strong stock price performance will see their weighting increase in the index, while those that underperform might see their weighting decrease. Reduced tracking error. Rebalancing helps minimize the tracking error between the ACES ETF's performance and the NACEX index. Tracking error refers to the difference in returns between the ETF and the underlying index it tracks. Regular rebalancing helps the ETF stay closely aligned with the index's performance. Potential for transaction costs. Rebalancing involves buying and selling securities within the index to achieve the desired weightings. These transactions can incur costs for the fund, which are ultimately reflected in the expense ratio of the ACES ETF. Investor considerations. Impact on short-term performance. Rebalancing can sometimes lead to short-term fluctuations in the performance of the ACES ETF, especially if there are significant changes in the weightings of the underlying holdings. Long-term alignment. While rebalancing might cause minor short-term volatility, it's crucial for ensuring the ETF remains aligned with the investment strategy of the ACES index over the long term. Comparison to other ETFs, the rebalancing frequency can vary among ETFs. Some clean energy ETFs might rebalance more frequently, monthly, or less frequently, semi-annually. Understanding the rebalancing schedule can help you manage your expectations for short-term volatility. What is the standard deviation, volatility, of the ACES ETF? The standard deviation of the ACES ETF provides a measure of its historical volatility, which refers to the up and down swings in its price over time. Here's a breakdown of what standard deviation means for ACES ETF and how to interpret it. Standard deviation explained. Statistical measure. Standard deviation is a statistical measure that captures the dispersion of data points around the average. In the context of ETFs, it reflects how much the daily closing price of the ACES ETF fluctuates around its average price over a specific period. Higher standard deviation equals higher volatility. A higher standard deviation indicates that the ACES ETF's price has historically experienced larger swings, both upwards and downwards. This translates to a more volatile investment. Lower standard deviation equals lower volatility. Conversely, a lower standard deviation suggests the ACES ETF's price has been more stable historically, with smaller price fluctuations. This signifies a less volatile investment. Standard deviation of ACES ETF. As of May 27, 2024, there are different reported standard deviations for the ACES ETF, depending on the data source. Morningstar reports a 3-year standard deviation of 38.78% for ACES ETF. FT.com lists a standard deviation of 38.93% as of April 30, 2024. Interpreting the volatility. Moderately high volatility, compared to the overall stock market, represented by an index like the S&P 500, the standard deviation of ACES ETF suggests it's a moderately high volatility investment. What are the correlations of the ACES ETF with other asset classes? The correlation of the ACES ETF, iShares Clean Energy ETF, with other asset classes plays a crucial role in understanding its portfolio diversification benefits and potential risk management within your investment strategy. Here's a breakdown of what correlations tell you and how they might apply to ACES ETF. Understanding correlation. Statistical measure. Correlation measures the degree to which two investments move in tandem. A correlation coefficient between -1 and +1 is used. Positive correlation, +1 to +0.7. When the correlation is positive, the prices of the two assets tend to move in the same direction. For example, if the stock market goes up, the ACES ETF might also go up, positive correlation. Negative correlation, -1 to -0.7. A negative correlation indicates the prices move in opposite directions. If the price of bonds goes up, the ACES ETF price might go down, negative correlation. Low correlation, close to zero. A correlation close to zero suggests little or no linear relationship between the price movements of the two assets. Correlations of ACES ETF. Stock market. The clean energy sector is still relatively young and can be influenced by overall market sentiment. Therefore, ACES ETF might exhibit a moderate positive correlation with the stock market, like the SP 500. During economic expansions, both the stock market and clean energy stocks might perform well. Bonds. Traditionally, bonds are considered a safe haven asset during economic downturns. However, the correlation between ACES ETF and bonds can be slightly negative or close to zero. This means they might not perfectly move in opposite directions, but might not offer significant diversification benefits either. Commodities. Clean energy is often seen as an alternative to traditional energy sources like oil and gas. Therefore, ACES ETF might have a weak negative correlation with oil prices. When oil prices rise, clean energy could become more attractive, potentially leading to a rise in the ACES ETF price. How has the ACES ETF performed during different market conditions? The past performance of the ACES ETF under different market conditions can offer valuable insights into its potential behavior in various economic scenarios. Here's a breakdown of how ACES ETF might have performed historically and what to consider when interpreting this data. Performance in bull markets. Potential for strong gains. During bull markets characterized by rising stock prices and economic expansion, the clean energy sector could experience significant growth due to increased investor interest in sustainable solutions. This could translate to strong returns for ACES ETF as it tracks the performance of the CIBC Atlas Clean Energy Index. Underlying stock market correlation. Remember, ACES ETF might exhibit a moderate positive correlation with the broader market. So, even in bull markets, its performance might be somewhat dependent on the overall market momentum. Performance in bear markets. Vulnerability to downturns. Clean energy stocks might be more susceptible to economic downturns compared to established companies in traditional sectors. This could lead to price declines for ACES ETF during bear markets. Limited diversification. As discussed previously, the correlation with the stock market and potentially weak negative correlation with bonds might limit the diversification benefits of ACES ETF in bear markets. Performance in volatile markets. Increased volatility. The clean energy sector can be inherently more volatile than the broader market. This translates to potentially larger price swings for ACES ETF during volatile market conditions. Impact of specific news events, policy changes, technological advancements, or major news events related to clean energy can significantly impact the ACES ETF's price in volatile markets. Are there any foreign exchange (FX) risks associated with the ACES ETF? Yes, the ACES ETF does carry foreign exchange (FX) risk. Here's a detailed explanation of why and how this risk can impact your investment. Underlying cause of FX risk. Global holdings. The ACES ETF tracks the CIBC Atlas Clean Energy Index, ACES, which includes companies listed on stock exchanges in the US and Canada. Since the ETF holds these securities in their original listing currencies, USD and CAD, the value of your investment can be affected by fluctuations in exchange rates. Impact of currency fluctuations. If you're invested in a ACES ETF using a different currency, for example, euros, the value of your investment will depend on the exchange rate between your currency and US dollar to Canadian dollar. If the USD or CAD strengthens against your currency, the value of your ACES ETF holdings will decrease in your home currency terms, even if the underlying share prices remain constant. Conversely, a weakening USD or CAD could benefit your investment. Example. Let's say you invest 10,000 euros, euro, in ACES ETF when the exchange rate is €1 equals 1.20 US dollars. This translates to approximately $12,000 US worth of ACES ETF holdings. If the USD strengthens against the euro to €1 equals 1.10 US dollars, the value of your $12,000 US worth of holdings in ACES ETF would translate back to approximately €10,909, assuming no change in the underlying share prices. This represents a loss due to FX fluctuations. Mitigating FX risk. Hedging strategies. Some investors might use hedging strategies to mitigate FX risk. However, these strategies can be complex and come with additional costs. Focus on long-term, over-extended investment horizons. The impact of FX fluctuations might be less significant compared to the overall growth potential of the clean energy sector. Currency diversification. Diversifying your portfolio across different asset classes and geographic regions can help reduce the overall impact of FX risk on your investments. Investor considerations. Investment horizon. If you have a short-term investment horizon, FX risk can be more impactful. For long-term investors, currency fluctuations might average out over time. Home currency. Consider the currency in which you'll need your investment returns. If it's different from the listing currencies of the ACES ETF holdings, FX risk is a factor to consider. Risk tolerance. If you have a low tolerance for currency fluctuations, the ACES ETF might not be the most suitable investment for you. Are there any alternative ETFs that achieve similar investment goals? Yes, there are several alternative ETFs that achieve similar investment goals to the ACES ETF, ALPS Clean Energy ETF. Here's a breakdown of some options, along with how they might differ from ACES. Clean energy ETFs with similar focus. ICLN, iShares Global Clean Energy ETF tracks the iShares Global Clean Energy Index, offering exposure to a diversified basket of clean energy companies globally, similar to ACES ETF. ICLN has a lower expense ratio, 0.41%, compared to ACES, 0.55%. QCLN, First Trust Clean Energy ETF, tracks the First Trust Clean Energy Index, focusing on U.S.-listed companies involved in clean energy solutions. QCLN has a slightly higher expense ratio, 0.59%, than ACES. TAN, Invesco Solar Energy ETF, provides targeted exposure to companies involved in the solar energy sector, a subsegment of clean energy. This might be suitable if you have a specific interest in solar energy compared to the broader clean energy focus of ACES. Factors to consider when choosing an alternative. Underlying index. Each ETF tracks a different clean energy index, resulting in variations in holdings, sector weightings, and geographic focus. Research the underlying index methodology to see if it aligns with your investment goals. Expense ratio. Compare the expense ratios of alternative ETFs. A lower expense ratio translates to potentially higher returns for you. Liquidity. Consider the average daily trading volume of alternative ETFs. While ACES exhibits moderate liquidity, some alternatives might offer higher liquidity for easier buying and selling. Geographic focus. Decide if you prefer broader global exposure, like ICLN, or a focus on the U.S. market, like QCLN, or a specific subsector, like TAN. Additional options. Actively managed clean energy ETFs. These ETFs are managed by fund managers who actively select and weight holdings. They typically have higher expense ratios than passively managed ETFs like ACES, but they might offer the potential for higher returns if the fund manager outperforms the benchmark index. Alright everyone, that wraps up our deep dive into the ACES Clean Energy ETF. So, is ACES right for you? The answer depends on your investment goals and risk tolerance. For long-term investors, if you have a long-term horizon and are comfortable with moderate volatility, ACES could be a good option for clean energy exposure. Remember, the fees are a bit higher than some alternatives, and there's some foreign exchange risk to consider. Alternatives to explore. For a broader global clean energy focus with a lower expense ratio, consider ICLN, iShares Global Clean Energy ETF. For a US-focused option, QCLN, First Trust Clean Energy ETF, might be a good fit. 10. Invesco Solar Energy ETF offers targeted exposure to the solar energy subsector. Remember, diversification is key. Don't put all your eggs in one basket. Consider adding clean energy ETFs to a broader portfolio alongside other asset classes to manage risk. No matter which ETF you choose, do your research and understand the risks involved. Before you invest, check out the resources in the video description below, and leave a comment letting me know what clean energy trends you're most excited about. Thanks for watching.